Hi, everyone. Welcome on Wall Street Talks. I'm Andrea Scotto, and today I have the honor to talk to Jose Torres, senior economist at Interactive Brokers. With previous experience at the Bureau of Labor Statistics and the FDIC, Federal Deposit Insurance Corporation, that some of you may have heard given the recent events in the banking sector in the US. Uh, your commentary, Jose, has been featured on Bloomberg, CNBC, Yahoo Finance, the Wall Street Journal. So it's a great pleasure to have the opportunity to talk to you. Thanks for being here.
Absolutely, absolutely. Great to be here. Appreciate your work as well. I'm looking forward to an exciting discussion.
Great. So I'd like to start off by inflation. It just dominated the economic discourse of the past year. And I like to hear from you. I like to guide us through the causes of this inflation wave and what you think is the main issue with it.
Sure. So the pandemic changed a lot of things, and monetary authorities, central banks all around the world, pumped in a record amount of liquidity into markets. They brought interest rates down, zero in most cases, most developed nations like the EU and the US. And then also the pandemic, that's the demand side. So that created a lot of demand for assets, caused a lot of labor disruptions, distortions. On the supply side, because of the health problems, you had a lot of delays, problems with factories, problems with agriculture. You had geopolitics, China, Russia, also contributing to inflation. So for a long time, the world was pretty much locked down and things changed significantly. And the money supply increased a drastic amount. And I think we've become complacent over the last 4 decades since the 1980s on the money supply, because what you've seen central banks have accommodated monetary policy rates at 0, 0.5, very low rates, and that failed to bring inflation to 3, 4, 5%. The reason it failed to bring inflation was because we had a lot of deflationary forces. Commodities were becoming a lot cheaper. Globalization, especially China's role in decreasing the cost of goods, right? So you were able to have an accommodative monetary policy and not have inflation. But the world is a lot different now, right? Europe can't depend on Russia like it once did for energy. The world can't depend on China like it once did to outsource all of manufacturing. Companies are now choosing security and stability over profitability. Companies are saying, we know this is going to be more expensive to change routes, to onshore in the US because costs here are so much higher. And that's going to lead, in my view, to a new inflationary regime where inflation is going to be around 4%. We've already seen central banks do so much tightening, a lot of quantitative tightening as well. So increasing rates, but also bringing the balance sheet down, banks not lending as much, all that tightening, and still we have an inflation problem, right? So I think that in combination, you have the central banks, the governments closing down everything. Those were the drivers of inflation when the pandemic first came around. And now the way the world's changed in response to the pandemic, geopolitics, a lot of folks retiring, not that many births, commodity complex being strained. An example here in the US, local producers, their break-even price now is around $60 to $65 WTI oil, right? Before they could make money at 45, 50. Now it's a lot. So things are much more expensive.
Dramatic.
And the world is, sorry?
It's dramatic, yeah.
Yeah. And so I think that's what's going to lead to the next, the future inflationary dynamic.
So you expect the long-term inflation rate, or like the 10 years perspective, to be 4%. So
I do. It's out of consensus call. Inflation expectations are well anchored, very well anchored. The 10-year inflation expectations, you see them, and investors are pricing in a market that's an economy, global economy that's going to go back to how it was pre-pandemic, and the factors just aren't there. So inflation is going to be structurally higher, and central banks won't be able to go back down to that 0%, 1%. They'll have to stay at around 3.5%, 4% to keep inflation somewhat in the realm that they want. I think that's
halving, which will still be halving what the current rates are, right? Because we are at 8% in the US, I believe.
So in the US, we're at 5.13%. So we will be able to count once I think we'll have a recession fourth quarter of this year in the US. Europe is already in one. I think that once you get into the recession, demand will come down, then rates will have to come down. But if rates come down too much, then inflation comes back up, right? I think the alternative to that would be allowing inflation to run and just as central banks just do whatever they want. But under the current regimes, the Bank of England, ECB, Fed, Norway, a few others, they're really important. They really want to tighten, and then China and Japan, they're doing the opposite. But it seems like overall we have significant discipline on the monetary policy front.
I was thinking about this. You're connecting from the US. I'm from Europe. There's been some structural difference. For example, you were mentioning the rise in prices of oil and gas, and Europe, especially Germany, has been hit a lot more than the US because we imported more than 60% from Russia. We were more than 50% dependent on Russia. And after what happened in Ukraine, importantly, but the US have great reserves of oil. So do you think, this is my question for you, do you think that the causes and therefore the answers to fight inflation should be different in Europe and in the US?
No, I think generally they should be the same. But I do think that the US has further to go. The US is going to suffer from more sticky inflation because the stimulus measures on the American side were much more dramatic. In Europe, you didn't have that much fiscal money going to households like you had in the US. So yes, I would think that it's going to be similar in the sense of interest rates. And on the supply side, US and EU has a lot of similar problems. Not enough labor, job openings still really high, unemployment rates still really low. So it's pretty similar across both regions.
But that is what I was trying to get at. Like unemployment rate is not rising as fast as expected given the rise in interest rates. So what's your view on that? Do you expect that we absolutely need unemployment rates to go up in order to end the inflationary period, or there's some other way?
I was on Yahoo Finance last week, and I got a little bit of heat for saying that you have to have the unemployment rate go up in this environment to get inflation back down. And the reason is the most problematic segment of inflation has been services. The way I think about it, you have commodities, you have goods, and you have services. The most labor intensive of those three is services, right? Goods, you have a lot of automation, you have a lot of computers and machines that can build goods. Commodities, same thing, a lot of technology that can produce that stuff on its own. Services, when I go and I fly to Milan, for example, right, or to Rome, there has to be people on that aircraft, right? They're driving the aircraft, they're serving me, drinks, food. If I go out to the restaurant, if I go to the amusement park, if I want to ride, that's where the bulk of the inflationary pressures are coming from. Also, that makes up most of the global economy now, especially in the developed world. It's not manufacturing like it was 50 years ago, right? So if you have all the inflation coming from services, which is very labor intensive, right? How could you not have the unemployment rate rise if you wanted to tackle inflation?
That makes a lot of sense economically. And one of the first things you study in economics is the Phillips curve, indeed. And according to what you just said, it seems to still work as a framework.
Glad you bring that up. Just to repeat what I said earlier, just in a different framework, the Phillips curve, it still works, but for a long time it was distorted because of deflationary factors on the supply side, right? The world becoming more efficient, technology, automation, all that made it where the relationship between inflation and unemployment became distorted because inflation was just significantly lower because of those factors.
Right. Another issue that's been fascinating for me, it's been the trade-off for central banks between price level stability, bringing down inflation, and economic financial stability, especially regarding to what happened to the banking system and to the bank's balance sheets. We're buying bonds, and after the interest rate rise, they've been hit quite hard. And what's your view on that, and how should the Fed balance those two policies?
Look, some banks have management that aren't that strong, that didn't do that well managing risk. And unfortunately, when you have tightening regimes, when the unemployment rate goes up, like we just said, there are some failures in business and there are some failures at banks, right? In the 1980s, you had, at the time, Fed Chairman Paul Volcker and FDIC Chairman Isaac. They understood that the cost of bringing down inflation was you're going to have some bank failures, and a lot of these banks were issuing mortgages and all kinds of long-term debt at 7%, 8%, and then rates went to 20%, 18%. So they just had to, unfortunately, restructure or have some problems, cut staff, recapitalize, and that is the role of banks, is to manage risk. And if you don't manage risk appropriately, then unfortunately you fail. As far as what the Fed is doing, the Fed already bailed out a lot of banks in March. They unleashed, during an inflationary battle, they unleashed $400 billion of liquidity into the market. Okay, England did the same thing late last year. Yeah, right. To save the banks and to promote financial stability, they unleashed liquidity into the market. What did that do? Asset prices went running. Financial conditions loosened. Bond spreads narrowed. Commodity prices increased, right? And when Powell was declaring victory in the February meeting, right? Now, oh, wow, inflation's a problem again. Because that's literally the conflict that you run into between financial stability and inflation. So he's trying to slow down, like when you're on the highway and you're 100 miles away from your destination, right? Let's say, you're going from Madrid to Berlin, right? So you're driving super fast, 100 miles an hour when you leave Madrid. But then once you start getting closer to Paris, right? And the city is in between Paris and Berlin, you start slowing down because you don't want to miss your exit, because you're getting closer to your destination. So the Fed's getting closer to its terminal rate, so it's slowing down. 75 basis points, 75, now 50, now 25, now a pause, one or two more maybe, right? So that's kind of how I see Chairman Powell sort of accommodating those two risks. Not trying to blow up the financial system, but also trying to maintain discipline on inflation.
Great explanation. And do you think that the worst is beyond our back, or do you think that there's still maybe some banks that are at risk, that didn't manage their risk so well, so that they are themselves at risk?
There's about 30 problem banks right now, and I think that you're going to have a few more. I don't think they're going to be large banks like SVB or First Republic or Signature, but you're going to have some smaller lenders have some problems. It's very difficult for them when a lot of the mortgages and debt that they issued 2-3 years ago at low rates, and now they have to pay so much to entice depositors, right? For example, Interactive Brokers were paying 4.58% on idle cash. Banks see that they have to compete now with Interactive Brokers, with all the other banks that are paying more. And you also have a bifurcation, right? Because those are the small banks that have to entice depositors. You know what the big banks are paying? Citi, JP Morgan Chase, those huge banks, they're paying close to zero, close to nothing. Why? Because they don't really want deposits. They have enough and they don't want more. So it's interesting bifurcation. Those regional players, smaller players that don't have a presence, that don't have an ATM machine every corner, they have to pay higher rates of interest, but their profitability isn't there, like the bigger banks. So it's a squeeze.
Anthony, Interactive Brokers, yeah, you made me think of the stock market. And we look at the stock market, some great popular stocks that are traded at very high PE ratios given the current interest rate policy. I've written down a few: Nvidia 220, Amazon 314, Tesla 75, and Phase 47. And I mean, the first three that I mentioned are now over $1 trillion market cap. So this is not irrelevant companies. So I'm thinking, how long can it last, really? Like, after all it happened, yeah, there was a downturn in stock market prices, but a lot of people may have expected something worse, and long term these prices are sustainable.
Let's go back to the Fed. In March, they added 400 billion in liquidity at a time when the market, the S&P 500, was flat on the year. Right now, you're up 17, 18% on the year. And tech stocks like the ones you mentioned are up a lot more, right? But in March, the S&P 500 went down to 3,800, 3,807, I want to say, something around there, which was flat from January 1st, right? And when does it end? It ends when you have a liquidity event, like what you had in March, and the Fed isn't so helpful, right? To the extent that the Fed continues to be helpful, if they repeat what they did in March, let's say we have a 10% drawdown because of some credit event for whatever reason, and the Fed comes out with a lot of money and flushes liquidity again, then it'll continue. It'll rebound right away. Same thing in the pandemic. They came out with the liquidity and it ran right away. The issue is that if you add liquidity, then you're losing on inflation, because inflation has another leg higher, right? So when does it end? Is with time. Does it have to be a credit event? No, it could just be tightening monetary conditions, people losing their jobs, they take money out of the market, right? Because markets over the long term are efficient mechanisms, right? And to your point, when you have a S&P 500 that's trading with an earnings yield very similar to short-term treasury bonds, right? Bills, it's not worth it to take that much risk, right? But you have an argument for higher PE ratios is retail participation, right? Since all that liquidity, retail has been unbelievable. I'm sure you see it on Instagram. Some of you watching here, you have the zero DTE options. People are making 10 times their money, 20 times their money in a single trading day. How do they do that? So the market goes down, they'll buy a call that expires that afternoon, that's 1% out of the money for like 3 cents. If that call goes into the money, now it costs $1. So 3 cents is turned into $1. So that's how they're making that much money. Not necessarily that specific math, but these kinds of mechanisms, this kind of speculation, these kinds of animal spirits, are what keeps those PE ratios high, and then you have inflation, you have higher interest rates. People want to make money. Also, home affordability here in the States, it's been terrible. It's been historically probably the worst overall, and some statistics do reflect that it's the worst affordability overall. And also with the declining birth rates, there's not as much of a propensity to save, right? People aren't having children. People aren't buying homes as much. Transactions are way down. So the propensity to save isn't that high. So folks are going to the market to invest. Some have labeled the recent behavior similar to a casino, but markets go through different episodes, right? And speculation in some years increases a lot, like it did during the dot-com bubble, and like it's doing right now. But eventually, in terms of your question, how long does this last? Over the medium to long term, markets are efficient mechanisms, and I think the price will reflect that. So I think we're going lower, just based on higher bond yields, sticky inflation, and earnings expectations that are really, in my view, too high, and a narrative that I don't believe is going to drive that much earnings power across the whole market, which is artificial intelligence, right? It's been around for a while. It's not something that was born yesterday. It's just that now is the time that, companies are focusing more on it. And I'm pessimistic on the level of earnings growth that artificial intelligence is going to drive. So I would be cautious in this market.
Yeah, it's understandable. I saw a report from Goldman Sachs the other day that was saying that they forecast an increase of productivity by 9% in the next 5 years. So that's important, but that's surely not the 100% increase in Nvidia in a couple of months. Yeah. So to the great asset management question that has been quite popular lately, is the 60-40 portfolio back, 60% bonds, 60% stocks, sorry, and 40% bonds back? You would say yes, given the approach to risk in investment that you were mentioning before?
I would say no, because bonds, yeah, their yields are higher relative to what we're used to, but so is inflation. And why do you invest? You invest because you want your purchasing power to increase, right? Mostly. Some are for other reasons, but I would say mostly is because you want your purchasing power to increase. So if CPI inflation is 4% and the 10 years yielding 3.8, right? And that's how it's going to be for the next year or two. You're losing money in some cases. In some cases, you're making. So what's the way to manage here? In my view, the way to manage is active management is making a comeback. Active management, right? Because what I realize is that when you have monetary policy discipline and tightening liquidity conditions, the role of the asset manager and the active manager increases because his or her skill can now be better employed in a world where resources are scarce and not abundant, right? Because when the Fed or the ECB increases liquidity, resources become abundant. So as resources become more scarce, liquidity resources, that those are, right? That gives active management an incredible role. What's another aspect that I like? Active brokers, by the way, unbelievable options platform in terms of price execution, in terms of research, and I can go on and on. But mixing the options combinations, shorting, selling puts, selling calls, longing, those kinds of combinations make a lot of sense in this environment.
Great. And another issue of the stock market has been that there's been an asymmetrical temporary bull run. So we've seen the top 5 stocks by market cap in the S&P 500 having incredible gains and the others lagging behind. Do you see this is something that is going to stay, or how is it going to change?
So the bulls hope that the rally widens out and breadth improves and you have better participation across. But I'm of the view that the companies that aren't exciting, there's a reason why they're not going up. Because economic conditions and earnings, aren't looking that terrific. They're not. And they have a cap on their PE ratio. So when you talk about excitement and you talk about, stocks that go up a lot and momentum, those stocks are doing amazing, So I think the way this progresses into year end is that those that were the leaders end up taking the most pain on the way down. When you look at the PE ratio of the companies that aren't participating, so if you take the S&P 500 and take out the top 7, right, or top 8, the PE ratio is a lot more manageable, right? Instead of around 20, it's more like 15, right? So you can argue what should the PE ratio be? So if you argue 13 or 12 on those stocks, then there's not that much downside, right? It's a little bit. I mean, there's some downside, but it's not like getting cut in half or doubling. But when you look at those PE ratios that you mentioned, 200 times, 80 times, 300 times, all that, you realize, wow, there's a lot of space for these companies to lose value, particularly if they don't meet expectations, which, by the way, are near the heavens, close to whoever, the viewers think God is, right? Really high. So you got to make those expectations just to justify the current stock price, right? So any disappointment, it's going to be dramatic. And one final thing I'll add on this point. These companies, their earnings are contracting, Andrea. They're going down. Compare them from last year. They're going down. Oh, you want to talk to me about the future? Great. But right now, they're going down. And in a tightening environment with I think is going to be a rising unemployment rate and rates that are going to be higher for longer, that's most central banks are saying, I don't see how earnings grow significantly from here.
Yeah, so certainly this divergence in earnings going down and prices going up, it's increasing risk premiums a lot.
And one thing too with earnings that people gotta pay attention to, and I don't think they do enough, is when the companies buy back shares, they reduce the amount of shares that exist, and earnings per share go up. But it's not because the actual net income of the business went up. It's because the company took money from the balance sheet to buy more shares, right? So that's not an organic earnings growth.
Yeah. One final question for you is, given your experience at the FDIC and the Bureau of Labor Statistics, I was just interesting as a student, as a master's student in economics. What are the lessons that by working there you learned that you didn't in college, if there are some?
Yeah. Oh no, there's definitely many. I mean, it's the professional world, the banking world, the government world is a lot different from the education world. And one powerful lesson, I think that most students should leave university understanding is that resilience and hard work is ridiculously valuable in any space that you work in. And I think that those are the main lessons that I've learned in those places. I've been very fortunate to have moved up pretty rapidly throughout my career in the places that I've worked. And part of it is some of the things that just seem so obvious, right? And that most people might do 2, 3, 4, 5 times the first 10 days, first 20 days, but maybe not over the long term. Be prepared, bring your pen and pencil, pay attention, work hard. Those kinds of values can really catapult one's career and one's trading performance in anything that you do in life. And I think that's probably the most important lessons that I've learned so far.
Thanks for the valuable advice. So thanks, Jose, for staying with us for this half an hour. It's been a great conversation. I learned a lot. Very curious about what you had to say, and I hope to stay in touch in the future.
Absolutely. Thanks a lot for having me, and I look forward to maybe joining your podcast again.
All the best. Have a great day.
Bye.
Bye-bye.